Good morning, everyone, and welcome to our weekly DATIQ market update. This is our update for January 25th, 2022, believe it or not.
Yeah.
I'm Ken Adamo, Chief of Analytics here at DAT, joined by Dean Croak, Principal Industry Analyst, Ned Damon, Principal Data Scientist, and we have a very special guest. We have Chuck Snow joining us, our Senior Canadian Correspondent. He's CEO of Traffics. Chuck, do you mind a quick intro to start off the show?
Yes, thank you. I'm the founder and CEO of Traffics, which was founded in 1979. I've been in the trucking industry since 1974. When I was 21 years old, I bought my first truck. Nobody would hire me as a driver, so I ended up buying a truck, and that was my introduction into trucking. And I've always had a passion for trucks and cargo since I was a little boy. I was introduced to it at the ripe old age of 8 or 9 when my late father was importing gladiolas out of Florida. And he had to be responsible for loading the trucks back. And I was just a kid, but I figured it all out and knew that's what I wanted to do. And I'm one of the lucky guys that does everything he wants to do in his life. So we've watched Traffics grow from a two-man operation, load brokerage, to I think we've got about 440 people now in 20 offices. So
that's awesome. Chuck, I have a quick question for you. Did Canada deregulate around the same time as the United States? So the U.S. was 1980, right?
Long story. But no, we were about 6 or 7 years later.
Okay.
We saw deregulation coming, and that's why we formed Traffics. We thought there'd be an awful lot more opportunity with a deregulated environment. And we had been running a small trucking fleet, which we built up to 12 trucks in a year, basically Hertz and Ryder trucks, and ran between Toronto and the US mostly. And then when we got a whiff of what was happening with deregulation in the States, we wanted to jump on that bandwagon. So that's when Traffics was formed.
Awesome.
Great story.
Well, sorry to go off script there and put you on the spot, but I figured I'd forget the question if I saved it for the end.
Not a problem.
All right, so I'm going to hit with the key points of the week. We're going to kind of fly through the market update content because we have Chuck on to talk about the emerging crisis, if you will, with the Canadian vaccine mandate. So key points this week: spot rates behaving, I would say, generally typically, but maybe not as steep of a decline as we would expect. Capacity on the West Coast is an interesting thing to study. Dean will have more on that. Reefer capacity, Arctic air, another reason I'm in my basement. We just continue to get snow here in the Northeast or Midwest. Chuck's going to talk about the cross-border vaccine mandate. And then National Plan for Vacation Day. And we're just 8 days away from Groundhog Day. As a born in Pennsylvanian, I'm hoping Punxsutawney Phil is hoping that spring's just around the corner here. So with that, I'll turn it over to Dean.
Thanks, Ken. Let's dive into this. And remember, the longer version of this is at dat.com/market update, where I'll have our weekly report out tomorrow evening with all the details. So let's dive into the load to truck ratio for dry van. Volumes dropped 6% last week, still close to triple the volume recorded last year. Equipment posts were down last week. As a result, the dry van load to truck ratio dropped about 3% to 9.39. In the refrigerated category, volumes have dropped about 32% in the last 2 weeks on the load post side. Last week, volumes were down 17%, so it's quite a big drop in the last 2 weeks. Equipment posts were down also. Load to truck ratio dropped 16% to 18.16. For context, 18 loads per truck is still about triple the load to truck ratio this time last year, just as a measure of how tight capacity still is. In the flatbed sector, volumes continue to climb following last week's gain. As you can see on the chart, they're rather surprisingly tracking very closely with 2018 and last year. So we're going to keep an eye on that. There's lots of similarities in both markets or both seasons. Volumes are about 87% higher than the same week last year. Equipment posts were down last week, so as a result, the load-to-truck ratio moved up to 92.05. Having a quick whip around our markets, on our market condition index, Even though national dry van loads moved decreased last week, volumes and spot rates continue to climb in some markets. As you know, we covered Winter Storm Izzy last week on the show. Didn't cause as much damage to the freight market as we thought it would. Spot rates are only up about 4 cents a mile to just under $3. Capacity is very tight in Philadelphia, though, on both the reefer and dry van side. Spot rates are up 7 cents a mile last week after dropping for the prior 3 weeks. Philadelphia to Atlanta, volumes are up 15% week over week. Loads to Chicago are up 13% week over week. Their loads move, so higher volumes out of Philly to Atlanta and Chicago. Spot rates are up on both lanes. Atlanta loads are averaging $2.57. That's up 16 cents a mile in the last month. Loads to Chicago out of Philly are up to $2.34. That's 35 cents a mile higher than the December average. And as a result of all the port congestions, West Coast capacity eased, not as much load board activity as volumes start to decline there on the import side. Los Angeles, Chicago is one of those sort of benchmark lanes we watched. After increasing 75% or $1.39 per mile throughout 2021, loads on that lane dropped last week by about 28 cents a mile to $3. Having a look at our market condition index for refrigerated, capacity was tight in the Midwest. As Ken mentioned, Arctic air has plunged into the country. Across the Midwest market, especially the upper Midwest, Iowa, Illinois, Joliet, Wisconsin, spot rates jumped 25 cents a mile last week to an average outbound of $3.94. That's excluding fuel. That's after decreasing for the 3 weeks prior. Chicago to Atlanta hit a new 12-month high last week for reefer spot rates up to $4.75. Following a 25% week-over-week increase in loads moved. As I mentioned earlier, reefer capacity very tight in Philadelphia last week. Spot rates have been steadily increasing for the last 3 weeks. Outbound Philly rates are up 2 cents a mile last week to an average of $3.26. Fairly typical this time of the year, though, in Philadelphia. It's a big port market for imports from Chile. Just under 50% of January's imports from Chile arrived in Philly. Grapes, blueberries, cherries. So lots of good loadings for carriers in the Philly market on the reefer side. Wrapping up our market look at flatbed, volumes continue to decline last week. Loads moved were down 6%. That's leaving national volumes down about 15% in the last month. Despite the downward trend, some of the lumber-intensive markets, including Montgomery and Tifton in the southeast, capacity extremely tight last week. Spot rates up 45 cents a mile to an average of $3.33. That's after decreasing for the 3 weeks prior. Having a look at our year-over-year look at spot rates, after going against seasonal trends in the second week of the year with a 4 cent per mile increase, national average dry van spot rate decreased by just under 2 cents a mile last week to end the week at $2.76, excluding fuel. One could easily assume a rate decrease points to capacity easing, and that may well be the case, but spot rates are still 70 cents a mile higher than the same week last year, and 81 cents a mile higher than week 3 in 2018 as the spot market rally got going. In refrigerated sector, spot rates have been around the same level for the last 3 weeks. That's unusual, I think, considering they normally cool off in January each year. Spot rates decreased by just under a penny per mile last week to an average of $3.16. Last year, reefer rates plunged 36 cents a mile in the first 3 weeks. To put the current tight capacity into context, rates are still 90 cents a mile higher than the same period last year. And lastly, with our flatbed year-over-year look at rates, after increasing by 3 cents a mile the week prior, last week's national average spot rate decreased by the same amount to end the week at $2.65. Flatbed rates are still 44 cents a mile higher compared to the same period last year and 56 cents a mile higher than this time in 2018. So that's it for this week's market update. If you'd like to find out more about what's happening in freight, go to dat.com/market update and download our long form report. Over to you, Ned, for the short-term forecast.
Hello, everybody. We're going to be looking at our forecast. We're going to start off with dry van. In blue, you can see the market rates observed by DAT, and then off to the right, you can see that there's pretty broad model agreement about the level. It's just the direction that's going to be a little bit different. In red, the short term is expecting rates to continue to increase with a small bump heading into the middle of February, up about 5 cents over the next month. In green, RateCast, our flagship model, is expecting rates to stabilize a little bit, drop maybe a cent or two, and then pick back up to the current levels heading into February. Our blended forecasts in gold and silver are mixtures of the two forecasts in different ways and in different amounts. And for these two blended forecasts, they're tracking a little bit more towards the short-term model. Recently, the short-term model has been performing better than the RateCast model. So that's a little bit of a surprise, but still Good to keep in mind. Next, we're going to be moving on to reefer. In blue, once again, you can see the market rates observed by DAT, and then off to the right, you can see our different forecasts. In green, the ratecast forecast is expecting rates to have the normal seasonal pattern assert themselves, although not quite as steeply as we've seen in prior years, dropping about 5 cents over the next month, and then a rebound of maybe a penny or two heading into the end of February. The short-term model is expecting a continued more or less upward trend, although the slope of that trend has been decreasing, increasing rates going up by about 5 cents over that period. The blended forecasts are kind of unsure which model to trust. Those are in gold and silver, and they're about splitting the difference, maintaining rates at about the current levels. Finally, moving into flatbed, once again in blue, we can see the market rates observed by DAT, and like with previously, there's pretty broad model agreement. Ratecast in green is expecting rates to stay more or less at the current level, and then increase heading into the later part of February. Our short-term model in red is expecting rates to more or less increase linearly through the next month, going up by about that same 5 cents. And then the blended forecasts tend to lean a little bit more towards the short-term model in this case, and those blended forecasts are in gold and silver. And that will take us through the forecast and on to our IQ question of the week, which is, how will the recent vaccine mandates impact truckload capacity on either side of the northern border?
Yeah, I'll get us started there before we throw to Chuck, because it's been lots of talk about it in the last week. Some of the big carriers that have been reporting some of their potential impact on drivers, it's kind of been met with a little bit of a shrug of the shoulders. A lot of them don't think it's going to be too much of a big deal. Although, as Chuck will tell us, there's a lot of protests going on around Canada right now. So there's lots to talk about here. I'm not sure how big of a deal it is in terms of its impact on capacity and how much the vaccine mandate has been linked to all of the other issues that are going on in terms of the sorts of things that drivers and carriers are thinking about. In terms of high diesel prices, carbon tax, things like that are impacting that market. So Chuck, let's throw to you and get your take on what's going on north of the border.
Well, the vaccine mandate has it's probably affected 15 to 20% of the drivers. The other 80 to 85% are fine. They're vaccinated and they're going back and forth across the border.
Right. And
I would say, there are groups of people, especially amongst certain groups. A lot of people from the former Soviet republics, Eastern Europeans, have this built-in mistrust for government. And they seem to be probably the largest ethnic group that is anti-vaccine, just because of their government mistrust.
Mm-hmm. Right.
And that makes up a fair bit of our driver force, especially in Ontario and in Quebec. So those are the ones that we can't send out, obviously.
Right.
So just in terms of like the actual tangible impacts of this, is obviously there is a lot of dislike and unrest, but do you think that it's going to have a tangible impact on the freight market, or is this kind of more noise without necessarily an underlying?
I think it'll have a larger effect on the spot market because most carriers I know up here of any size, even people with 10 trucks, they use contract freight. They haul particular lanes for their own customer or for brokers. That's all they do, and it's set up and forget it sort of thing. It's the ones, it's all the extra freight that's non-scheduled that ends up on the spot board, and I think that's where you're going to see rates skyrocket. We've already seen it.
Right.
So your prediction then is that spot rates are going to be pushed up by the impact of these mandates and general kind of labor unrest within the trucking sector. Yeah.
I think any shippers that haven't locked down carriers with contracts or brokers with contracts are going to have to pay an awful lot of money for that freight that wasn't locked down.
Yeah.
Chuck, do you think you think there's enough drivers though that are vaccinated that can run cross border? Like if you've got a fleet, is it just as easy to switch your vaccinated drivers in to handle those cross border moves, or do you think fleets are going to increasingly do sort of cross border transfers with a select group of drivers and then transload freight or have a drop and hook situation either side of the border?
I think you're going to see. You know what? Truckers are the only way we stay in business is we are creative, and
right.
that's exactly what we're going to have to do.
Right.
Is drop and hook. So you'll have somebody, and I'll use an example. Somebody's going to leave Toronto or Montreal and drive to the U.S. border point, but not take it across the border.
Right.
And a vaccinated driver will come and they'll switch trailers, and the vaccinated driver will, instead of getting a chance to come home, he'll pick up his loaded trailer and hand off his loaded trailer in Windsor, Ontario, Sarnia, Ontario, or Fort Erie, Ontario, for example. And then those drivers will just, they will be running a little bit differently. That's all.
Yeah. I would be curious. My expectation is if you're having to do these kind of moves, I think it will ensure that the freight gets across, but I think the throughput would go way down because you're going to have to do a lot of jiggery pokery to shift things around. So if that's the case, then I would expect spot rates to, like you said, go a fair bit up because there's just going to be less volume total that's getting across the border.
Right, and most carriers and brokers, for that matter, even with contract freight, they're in this wild market that we've had for the last couple of years. There are quite often provisions within those contracts when things get out of hand, like what we might see. There's usually some sort of addendum in those contracts so that we can charge a little bit more, not on all, but on some.
Right. Mm-hmm. Chuck, I had a look yesterday on our load board. Some of our volumes, one of our bigger lanes is, of course, Detroit to Toronto, such a heavy automotive lane. Volumes are up about 17% in the last month. Spot rates are up 31 cents a mile on that particular lane, averaging 340. So there's already some volatility on that market. And I'm wondering whether that's, all the noise around the vaccine mandate, carriers deciding that they're not going to run into the US and vice versa, or it's something, more closely related to things like the Ambassador Bridge being, down to one lane each way, or just congestion at ports in general, or is it just simply winter?
I think it's winter. Now, I just checked through my sources here, and nobody knew anything about the Ambassador being, for sure, being closed permanently, at this time anyways. It may have been one night or so. They were doing some construction or even snow removal.
Right.
So I don't know exactly what that was all about.
Yeah. Doesn't take much.
No, it doesn't. And that's the busiest bridge crossing between the two countries.
Exactly.
Chuck, if you had to think about like inbound from the US, outbound to the US, and intra-Canada, do you think they'll all be impacted relatively the same or one more than the other?
Actually, your cross-border is going to be impacted the most, and it'll be, I would think, the inbound. Outbound is already in. Great question. I have to comment because your outbound is it's impacted already, just because there's not enough trucks to haul it. Your inbound, whether you're not going to have trucks in those areas, let's just say in Phoenix, to pick up loads because there just won't be any trucks there. I'm talking to one of my offices yesterday, and he was having some difficulty in some parts of the Southwest US trying to find capacity to come back up to Montreal. So that is, that's going on. So I would have to say that the inbound from the US is probably going to suffer a little bit more than anything else. I think eventually what will happen, the domestic Canadian market, the rates will go down because remember, this is all about supply and demand. As we have more drivers that can't cross the border or won't cross the border, that will make more availability of trucks and drivers to do domestic Canadian. Now, right now, the domestic Canadian market is pretty brisk. It's as good as I've ever seen it, if not better. But who knows how long that's going to last for.
One more quick. Oh, sorry. You go ahead, Dean.
lots of rumblings about protests this week, Chuck. There's lots of Facebook posts about, hundreds of thousands of drivers protesting, heading to Washington to park out front of Parliament House. What can you tell us from your vantage point in Milton?
Well, as far as Canadians go, this thing started out, as best we could tell, from some truckers that wanted to change Canada's vaccination law, allowing them to not have to be vaccinated. And that, even if our prime minister came out of his house today and said, you know what, truckers don't have to be vaccinated to cross the border anymore, that doesn't change anything, because the Biden administration has made it clear that no trucker is coming in from Canada or Mexico without being vaccinated.
Right.
So that, that was the original point of this entire protest. Now it's caught on. We do have a fundamental right in Canada to protest. Personally, I've never really been to a protest in my life, except for when I was in San Francisco once on a business trip. I needed to cross the street, and there was a rally against Trump's inauguration, and I actually had to walk with the protesters to cross the street. That's the closest I have been to a protest in my life. But barring that, the protest is more, I think people are just fed up with being locked in their homes and not having the freedom they'd like to do. Not all people, but a lot of people. And this is just, they're venting. As of last night, they had, through a GoFundMe page, they had already collected $3.7 million. But now this is interesting. GoFundMe put a hold on the account, not allowing funds to be distributed, because they want to make sure that they're going to get distributed in the right areas.
Right. Yeah.
So it's interesting.
Yeah. Yeah. Ned, you had a question?
Yeah. Well, it was more of a comment, but I know that a fair number of folks will essentially detour through Canada to avoid having to go around the Great Lakes, and that's going to heavily increase the mileage for people who are used to I forget what the exact terminology is, but when you're heading from the Pacific Northwest over to the Northeast,
going in bond, right?
Yeah.
And we've been doing the opposite. Our trucks have been going. We've been moving a fair amount of freight out of British Columbia, and because of some of the issues in British Columbia with floods. All sorts of roads caving in, the disasters we've had. The U.S. government has they really bent over backwards to accommodate Canada, and they made it much simpler for Canadian truckers to take everything in bond. So what we would do is we would cross over at Pack Highway, which is at Washington, Washington State, go through the states, and then cut back into Canada. With seal trailers with a custom seal on the trailer. And when you get to the U.S. side of a Canadian port of entry, you go in and you cancel the bond. It's very simple.
So essentially running the I-90 all the way across rather than Trans-Canada.
That's right. And a lot of drivers, myself included, would much rather go that way than the goat path going through Canada.
Right.
So we have some listener questions if folks are up for them.
Wonderful.
One question from Gary Bates. Have the DAT products increased in price, and what does the broker load board do? I don't know that I want to comment on the price increase. I think it depends on the packages and exactly what you're comparing. As far as the broker load board, does somebody want to take that?
Prices? Sure, I can tee it up, and maybe Chuck can fill in as an actual user. Maybe not anymore, but I'm sure he is.
You know what? Our trucks do. So it's all supply and demand. Certain lanes are brutal. You couldn't get a load out of there if you tried. And other lanes, as Dean had mentioned earlier in the show about Philadelphia, last week was a hot lane. This goes day by day. It's all about supply and demand.
Chuck, I had a question that you were talking about Phoenix, and I may have my days off, but there's a particular day that a lot of intra-Canada, so northbound loads get moved out of the US. And I think it's got to do with when carriers leave home Sunday for Monday delivery, and then they reload back out Tuesday and Wednesday back to Canada. Is there a real day of the week effect here with the intra-Canada northbound loads?
Well, you know what? It's how it normally works. It depends. You got to remember, Canada is a huge country. You know, so when you talk about Canada, what part of Canada? Because there's a real active lane between you know, Arizona and Alberta and BC. There's a lot of freight that moves in and out in that lane. There's certainly a lot going into Ontario and Quebec and coming from Ontario and Quebec.
Right.
What normally happens with your Ontario and Quebec carriers is they will leave because it's a long haul from Montreal, for example. It's 3,000 miles almost, about 20, I think it's about 2,900 miles from Montreal to Phoenix. So those drivers will leave on they'll leave on a Friday, and they will deliver in Phoenix, let's say on Tuesday. They will reset, and then they're available to load on Wednesday night, Thursday morning.
Got it.
And that's when a lot of the activity. So that's how that usually works. Nobody usually sends a truck unless they've got something scheduled sitting on a dock. No one usually sends a truck from Montreal or Toronto to Phoenix on Monday or Tuesday, unless it's a team. That's different.
Yeah.
But for single drivers, Monday or Tuesday, you wouldn't normally leave to go down to that area because it doesn't give you enough time.
Got it.
Just mechanically, to go back to the prior question about the broker load board, I mean, it's a load board. Brokers post their loads there to try and find carriers to carry their loads. If they don't have somebody lined up, they use the load board to try and identify, to fish for folks who will help them to move that freight. We have another question from Gary Bates. Why are brokers hanging up on a carrier offering services at market rates?
Are all brokers hanging up?
That's a very loaded question. That is semantic baggage.
There are good brokers out there. There are bad brokers out there. There are wonderful brokers out there that have some bad people working for them, and there are some horrible brokers out there that have wonderful people work. You know, it's all over the place. Somebody has a load to move. Market rate is $2,500, and they're trying to move it for $2,000 because they have a contract rate. That usually happens with a smaller broker who hasn't built anything in. And you know, in this market, it's very important to have that built in just in case. So I can't really comment on somebody else's behavior in the industry, but it doesn't surprise me. You know, you hear all sorts of stories.
I mean, I think market rate is up for debate, right? I mean, if it's the true market rate, I can't imagine very many are hanging up.
You know, it's everything. It has come down to supply and demand.
Yep.
Nothing else. We unfortunately or fortunately, trucks have become commoditized. You know, years ago it was, you know, a load out of Chicago paid $700. A load out of New Jersey paid $700. I remember a trucker called me one day, a friend of mine, Jimmy Doyle, and he said to me, "Chuck, did you lose 3 fingers in a boating accident?" I said, "No, why?" He said, "Because every time anybody asks you what a load pays, you put up 7 fingers." Because back in those days, we were brokering out mostly short haul freight.
Right.
You know, it's 40 years ago.
Right.
That's funny.
We have one final question before. Speaking of BC to Arizona flatbed freight, do you see dwindling capacity? I'm struggling to cover that lane, from Ryan.
It's a big lumber lane, right, Chuck? Out of softwood lumber.
That's probably on flatbed is it's the biggest export out of BC.
Yeah.
And with housing starts all over, you know, you've lost so many houses in the past year due to forest fires. They've all got to be rebuilt.
Yeah.
You need wood.
But hasn't the US doubled the tariff on imports, so that will be affecting some of the capacity, like in terms of the cross-border movement of trucks?
I don't know whether it'll change things or just make houses more expensive.
Right. Okay.
Because they need the wood. There's not enough wood.
Right.
There's still a shortage of lumber.
Yep. And that nasty beetle has been eating a lot of the trees on the eastern face of the mountains,
it's doing it in, it's doing it in Alberta and British Columbia too. That Asian pine beetle, and that's they've had fires out there as well.
Yeah.
So this is a continent-wide problem, maybe even a worldwide problem.
All right, are we ready to close out the show?
I think so. Chuck, do you want to? We actually have someone else to give a plug where they're going to be because someone else hosts the show. You want to give a plug for where you'll be? I know Dean was talking about it before the show, but I don't remember, so I'll turn it over to you.
First of all, tonight, Tuesdays, we do a Rates and Lanes. My co-host Rico Muhammad and me, which is a call-in. It's a call-in podcast, or you can look it up online. But if you want to call in and participate, we always have interesting guests. And if you want to call in live, you just dial 1-563-999-3508 every Tuesday at 7 p.m. Eastern Standard Time. Quite often we have Dean on as our guest.
Yep.
Cool.
Great show.
Dean?
Yeah. DAT will be on landline now at 7 p.m. Eastern tomorrow night on Sirius XM Road Dog Channel 146. And I'll be on with Jimmy Mack and Dave Nemo on Thursday morning at 8 a.m. Eastern, talking about trucking and the freight market.
Awesome. And Ned, I think the last couple of times we've jokingly turned it over with you, but I think towards the end of this month, very early next month, we'll have some interesting things to share about some new spot rating tools, right?
Yes. We have a new rating paradigm that I think is going to be really interesting and help to give people much more accurate, much more targeted rates for their shipments. So
things like hazmat, non-hazmat, pieces, dims, and weights. So I think that's going to be really exciting.
Wow.
If anyone's listening that has a spare developer or someone that knows Python's web API package and is interested in maybe taking it for a spin in a month or so, you can always drop us a line at askiq@dat.com. We're looking for some kind of pre-alpha testers out there.
Guinea pigs, yes.
All right, so with that, I want to thank Chuck for joining us. I think we're going to have to make this a regular thing, Chuck. This was really good information.
Yeah.
Thank you, Chuck.
I really enjoyed it, gentlemen. I can't tell you how much fun this was.
Yeah.
All right, we'll have to get you back here maybe whenever things thaw out north of the border.
Stay healthy, everybody.
All right. Later. We'll see everyone next week.
Okay. Bye-bye.
Bye.
Catch you.